Still there is some issue with the pen, but I will continue my lecture. You know that in last lecture I discussed about efficient market hypothesis, and this efficient market hypothesis is a very important concept in finance. As I told you that the foundation of modern finance depends on the efficient market hypothesis. So what I will do that I will take some of the remaining issues with the associated with the efficient market hypothesis, and then I will go on to discuss other aspects like the one part of the fundamental analysis is economy and industry analysis, which I will take up today. You may recall that in last lecture I discussed that the efficient market hypothesis means that stock prices reflect all the information, and these information, by using these information, one cannot earn abnormal profit. In efficient market, the prices reflect, when I say prices reflects all information, it means that the information may be related to the past prices, past information, it may be related to public information, it may be related to the what we call the private information. Past information means that by studying past prices of the shares, one cannot predict about the future prices and therefore cannot make abnormal return. So abnormal return cannot be made by studying the past prices, and therefore just 1 minute, let me check it. So still there is an issue. Okay, just leave it. So it cannot be, the past prices cannot be used to make this creating. Okay. So what may happen that if you can study the past prices and predict about the future, then what may happen that if there is a history in the prices, and that history can be used to predict the future prices and can be used to make abnormal return. Please remember the fact that the stock should provide a return which is in line with the risk. If it is not providing a return which is in line with the risk, then it means that the people will share the share and buy the share which is providing the return in line with the risk involved. So this is the crux of the efficient market, and it has got 3 forms, which we call weak form, semi-strong form, and the strong form. So the weak form, as I explained to you, it tells us that the stock prices cannot be used for the predicting the future prices, as that is the past prices. A semi-strong means public information, and a strong form means the information which is private, which is like the executives of the company, or which is a preview to few individuals, that also cannot be used. So overall, we have got levels of market efficiency. One level of efficiency is weak form, another is semi-strong, another is strong form of market efficiency. Now, this idea of EMH, as I said, that provides the foundation. Foundation means that on which asset pricing model like CPM is based. If this foundation, that is market, is not efficient, then those models will not be valid. If market is share prices do not reflect this information, then there might be these deviations from the price and the value, and therefore that information, some information can be used to make abnormal profit. I am repeating the word abnormal. Abnormal means more than mandated by risk. So, but in recent time, what has happened that there are various departures from the market efficiency. But before that, departures mean that there are deviations from the market efficiency, means that the market efficiency, this hypothesis is not valid. And there are some exceptions to these, there are some violation of these hypotheses. So let us first understand that if market is efficient, fully efficient, then there is no point. Fundamental analysis cannot make us to earn abnormal profit by using fundamental analysis. Fundamental analysis based on economy-wide information, industry level information, and company, which I am going to discuss next. So you cannot make a profit by using this. When I say profit, means abnormal profit. Return should be in line with this. So, and similarly, a technical analysis which is entirely based on the reading of the history of past prices will not be profitable. So both fundamental analysis and technical analysis will not pay to earn any abnormal return. But in recent time, what has happened that we have seen various departures from all these are given in my slide. I'm leaving these things because of the paucity. There are various violations of efficient market. Like what has happened that in recent time there are various, the high level of the volatility is there in the market. This volatility is high level in the sense that it is volatility, as you know it, one of the measures of volatility is by which we calculate, say, standard deviation, how much the stock prices have moved. This volatility of stock prices is too high to explain by any. For example, there is no news, yet the prices of stocks fluctuate too much. For example, price may move because the company's performance, some news about the company, some news about the industry, some news about the company economy, which may affect it. But this is not the case, because what has happened is that the prices are moving too much, and that cannot be explained by the information and its release. So this is one important. And then it has also been found that the stock prices overreacts, and this trend is over to 1 to 3 months. And then, for example, if any stock is performing well, which we call momentum here, then it continue to perform well in the next two, and then after certain time there is a reversal of this. That it means that the stock prices, they revert themselves. So that is why in the short run, for example, 1 to 3, it may, and then the stock which have performed well, they will continue, and after that they perform badly, and after a certain period of time they revert back. So this is also not can be explained. And then there are certain strategy, like you form portfolio based on book to one or size. Size means market cap, market capitalization of stocks. For example, high to low, sort the stocks on book value to market value, and form two portfolios, high and low, and difference. So this difference is significant. So these are the still information. These information has already been calculated, yet they continue to provide some the excess return than mandated by. These are not explained, cannot be explained. Then stock prices, certain insert like the stock price crash of 1987, when prices of stocks went down by 22 points, almost one fourth of the value of the market was wiped out in that day. How can you explain if the market is efficient, then this much, reaction? Or sometimes if stock prices, they move too much. So no announcement, nothing. But and then there are certain things which are not relevant information, like if any stock becomes part of index like Nifty or something like that, and then prices start rising up. So that is why these are not something which we call information, yet prices move. And then one more phenomena is that which we call bubble. Bubble is a phenomena when the prices are more than their fundamental value. Prices are more than their fundamental value. Like if you use the dividend discount model or some other model, so if the prices are too much then justified by the fundamental value may be based on the company level performance, industry and economy. So that affect the value of a share. So those may not be, that may be much higher. So it is very difficult to explain why prices went up. Like a financial crisis of 2008, when the certain stock prices and certain asset prices went up too high in the market, and then there was. So it is very difficult to justify this. And so what is the response? The EMH, the market is efficient. Prices reflects all the information. You cannot earn abnormal profit by using the past information. And simply a buy and hold strategy will pay. And like that, these are some of the. And if there is a deviation from some price from the value, then arbitrage process, that you will buy the under price and sell the over price, and there will be convergence between price and value. So there will be convergence. They will move, price and value of they will move. So if there is any deviation. Now, the various the events and various the strategies which I just explained to you, like momentum and other, they are posing a great challenge to market efficiency. That market is not all efficient. It may be efficient to some period, or it may be efficient in certain stocks, but it may not be macro efficient, because in market, the players, those who operate, they are not everybody is rational. There are irrational players as well in the market, if we call noise traders. They do not act on information. They may act on something else. So it is a rational versus irrational. And in sometime it happens that there is no news, but these sort of players, these called rational, they may dominate over the rational. And that is why the prices, for example, the recent times in India also and elsewhere, prices have gone up too much on the expectation of, although there is no news. And in recent times, you see that the stock prices are coming down because there is a fear of inflation. So that is the inflation affects stock prices and other, in one way or other, that will affect it. But that, so that is why the entire explanation that market is efficient, therefore government should not intervene in the market, is not fully supported by the empirical evidence, because there are challenges which cannot explain by a rational model like that. And in response to that, a new discipline has emerged, which we know as behavioral finance. And behavioral finance, which you will study in the next semester in detail, I will just briefly discuss. that the rationality assumption may not prevail. And there may be deviation from rationality. People make bad decisions. So it tries to bring psychology to understand the human behavior. Like sometimes we do not follow the herding behavior. If some other people are buying, we start buying. For example, sometimes in the way information is presented, we may act upon that. So although the framing of information in final analysis may not be different, yet the way the information is presented, positive or negative frame, it may affect the decision. So it tries to understand this behavior, and it says that people do not make complete rational decision. They satisfy only, which I have briefly discussed in my class of economics in the beginning in objective, that people have limited ability to process information. In other words, their cognitive ability limited. They succumb to emotions, and therefore they may act on sentiments, and which we call, and they may not act information, something which is not related to information. This noise, nothing, no news is there. Yet they may act, and they may use shortcuts, heuristics, rule of thumb. And these departures, when they happen, then what happens that the prices may deviate from their value, and market may not be efficient because some other forces are at work. That is why behavioral finance tries to incorporate insight from psychology and economics to understand how real people make decisions. And when these people they take decisions, then what happens is to the prices of shares, or how they affect the share prices or asset prices in the market. In other words, using this framework, we try to understand human behavior and their investment decision. So behavioral finance is a discipline, which we will take up in next semester in detail. Try to look at, for example, why there are certain anomalies which are difficult to explain. Why these phenomena like momentum, where price, if they continue to perform well, or why the car companies, they try to time their IPOs, and sometimes they take too much, sometimes they spend too much money on acquisition, which we call winner's curse. And sometimes how the various factors like overconfidence of CEO, they affect their investment decision. Although rational assumption means that one will be neither overconfident nor underconfident. And how this affects various like procrastination, loss aversion, narrow framing, and all these factors, financial literacy. These factors, they affect the human, whereas the rational framework point out that we neither procrastinate nor delay anything. We are well in time also. So that is why EMH, efficient market hypothesis, is although provide the foundation for the modern finance, yet in recent years it has been pointed out that there are violations of these, there are challenges, market may not be fully efficient, and therefore when it happens that there might be certain opportunities for profit making. Just I would, in conclusion, I would like to point out that there is an economist, Joseph Stiglitz, who has received Nobel Prize in Economics for his contribution to asymmetric information. Stiglitz and Grossman, they point out that it is not possible to have a fully efficient market. The reason they point out that market efficiency demands that the information should be processed, information. And when the information is used for investment decision making, then there might be analysts, security analysts, those who will use this information, and when they use this information, it gets incorporated in the prices, through buying and selling decision or hold decision. So and these people, they are, they will have only the incentive to process this information only if it pays to them. Otherwise, if the market already reflects all the prices, reflects all the information, then what is the point in analyzing this information? So he says, they point out that at least market will be that much inefficient so as to compensate these people. Otherwise, they will have no incentive for processing information. And market efficiency demand is a kind of paradoxical situation. Market efficiency demand that information should be processed. And the people who are involved, they will have only incentive if it pays to them. Otherwise, they will have no incentive. So for that, market may remain inefficient or will be efficient or will not be fully efficient. So they said that it is next impossible to have fully efficient market. And we can understand through behavioral finance now, because that when you look at the real investment decision making, because human beings, their cognitive ability to process information, their horizon of investment, they are very myopic, and they are affected by various things which are not related to the which are noise, not information, and they are affected by. So that is why they may not optimize the decision. They may be affected by emotions, sentiments, and other factors, and they get translated into the stock prices. And because of that, so these details I will take up in next semester in more detail, because entire paper is there. So I close here and move on to discuss some other things. If you have any question, you can ask. You know that there are two ways to analyze any security for valuation of a security. One is called fundamental valuation. Let us say an equity we want. And there is another method which is antithesis of this, technical, which I will also touch upon, but after this. Technical analysis looks at the history of the stock prices. And just now I told you that efficient market says that there is no point in studying the history. So it is like, they make chart of the past prices and they try to predict about the price movement. And studying the past to predict the future. And they have also various tools to predict it, where the stock market is headed. So they do not take any. Whereas the fundamental analysis is rooted, the word fundamental. It is three-level analysis. First we look at economy, industry, and lastly we look at the company level. So it is economy, industry, and company level, any individual company level. All the companies, they operate in the economic factor, that is the macroeconomic factors and other factors, they affect the and these companies are affected by where they are operating at. So we'll try to look at those factors which affect the stock prices or the performance of the company. Please remember, whenever I talk about price valuation then naturally behind these stocks or there are companies on whose performance the 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 equity prices matter. Just one minute, please. So what I will do that today, that I will try to look at those factors uh, which affect it, and you have already studied those factors. So I will be very brief in my explanation. Only I will tell you the concrete part, the main part of this. I will not go into detail of, for example, like I will explain to you entire monetary policy, fiscal policy. I assume that you know it. If you do not know, please refer to my notes of macroeconomics last first semester. So what the fundamental analysis says, that a firm's value comes from its earning prospects, which are determined by economic environment global, the economic factor that affect the firm industry where it is operating, the industries, the effect of economic factor industry wise differ. Not that IT will be affected or a particular sector or the food industry or like, there are variation in the effect of the economy wide factor and where the firm operating in, what is the position of the firm in the industry in terms of competitiveness. So we will try to look at these factors, and here I will discuss about those macroeconomic factors. And here typical framework like Porter's framework or industry life cycle will be highlighted. Now, if you look at the global, economy and their factor, that we are living in a world which is globalized, and globalization can be, understood by its linkages, how integrated a country is. One way we can look at the linkages through export and import. Another way to look is the investment flows. How much is the foreign trade sector? Foreign trade sector contributes to the economy. For example, if this part is very high in national income, naturally the linkage will be very high. Similarly, how much investment flows in and out of a country, and other factors as well, like movement of. But that for economy, for the economic analysis, we are looking at. So and nowadays we may also try to understand how much linkage is there between a country and another. For example, if you look at the Sensex or Nifty, and we try to look at what is the correlation between Dow Jones and Sensex. Normally, we find that if the correlation is very high, then economies may also move together. There is a what happens in one part may be affected. Correlation is high, means and if these. So that is why we are living in a world which is globalized. What may happen in one part will affect other part. Like financial crisis of 2008 affected. If, for example, IT export may be affected because of recession in the exporting countries. But if domestic economy is in recession and other countries are in prosperity, so what is shortfall in domestic sales may be compensated by the upswing in other countries. That is why it cuts both ways. So whether the global economy is contracting like that, so all these. And then when you are looking at this global environment, then there are political risks also involved, exchange rate risk involved, and exchange rate risk affect the price of imports and import via depreciation or appreciation of a currency. Whenever you are trying to look at how the exchange rate risk may be involved. International finance, you will be studying these things, how they affect it and how can one manage it. You know, so like if the rupee becomes costlier, that is, appreciates, then export may be costlier to foreigners. And if rupee depreciates, the goods may be cheaper to the foreigners. Or how can one manage the risk? For example, when you translate it, the export earning back to Indian rupee, then it may be affected. Or it's a operational, that is competitiveness, exchange and rate may be affected because of that. So all these are, for example, there are various techniques like one can use options, futures, and forward to manage the risk, but that is a different story. But exchange rate movement. Then this relationship between in the exchange rate and is explained by two theories which you may have studied. So in international finance, one is purchasing power parity theory, another is in international Fisher effect. I will just explain these things in 2 or 3 sentences, the crux of it. Purchasing power parity theory says that the exchange rate should move to offset, to correct the inflation differential. Inflation is erosion in the purchasing power, and exchange rate is the price of one currency in terms of another. India and USA 2% inflation, India 10%. What this says that there is 8% difference in India inflation. Exchange rate should move by 8%. It means that rupee should depreciate by 8% to account for this erosion in purchasing power, which we call purchasing power parity. But in real life, it may not be absolute. For example, economists prepare an index based on purchasing power, like Big Mac index. For example, certain products are taken, like Big Mac. What is the price in USA? And so they take a ratio of this thing, and they try actually how much exchange rate deviates from that. Actually, it will not. There are a lot of deviation because transportation costs are there and other things are involved. So in short, purchasing power parity theory links inflation differential with the exchange rate. International Fisher effect is named after Irving Fisher. It says that countries which have got high inflation, they will have high interest rate. It means that countries which have got high interest rate will have depreciating currency. So this is the prediction. Naturally, inflation erodes, and interest rate is the price of the fund. So if inflation is high, the interest rate should move to compensate for. So it simply says that, in other words, that the exchange rate will move to offset the interest differential, and interest rate will vary because of the inflation differential. So it is that the countries which have got high interest rate, they have high inflation, and those countries which have got high interest rate, they will have depreciating currency. So these relationships are important to understand how the global business gets affected, because So I'm coming to domestic economy. Whenever the earning prospects are good, the stock prices rise. P is one of the indicator about the performance of the economy as a whole. For example, high P ratio shows that there are chances of growth in the economy, and that is why the market, in fact, takes into account these things and tries to incorporate. So let us see what are the various factors which affect the domestic economy. One is GDP, national income, unemployment, inflation, interest rate, budget deficit, sentiment. Some of that GDP is consumption, investment, government expenditure, and export minus import. So how much we are spending? Let me show to you. Okay, so national income, this is also called national income. So national income is driven by consumption for durable and non-durable, investment by businesses in machineries and equipment, and government spending, whether government is running how much government is spending, and export and minus import. This is export and this is imports. The difference is called net trade or net. So if you are exporting more than, so it will be positive, and it is less, then it will be negative. And this is very important. As I told you just now, some countries like Southeast Asian, more than 40% of national income is from. So therefore, anything happens in this foreign trade sector affects them. Indian economy, the linkage is not that much. There are contribution in hardly 2 or 3%, maximum. So therefore, domestic economy is very, very so. And this total demand in the economy is driven by either consumption demand, or businesses make investment to create jobs, and our government. For example, in recession time like COVID, it was said that government spending should increase to boost the economy. And government spending depends upon whether how much government is spending, whether government is trying to invest, make expenditure using deficit financing, to what extent they are doing it. So domestic GDP, and it is one of the most important indicators of the health of the economy. Like in India, we are talking about that economy has recovered, whether it is V-shaped or it is K-shaped. That is, certain sectors of the economy have gone up, but still some sectors of the economy are still, they have not gone up. V-shaped means that now you have come, and then there is a rebound here. So various kind of, but most it's like K-shaped. Some sectors they may have revived, but other sectors are still less. So that is why GDP is one of the important. And if GDP projection is high, means the economy will grow. Economy will grow. It simply means the businesses and other will also be positively affected because of that. So whenever we are looking at the analysis, then we try to look at the price of anything is determined by demand or supply. So see the capacity of the economy. Sometimes it happens that we are having lack of demand. What has happened in COVID? Unprecedented situation. And normally it happens that lack of demand may be there and GDP may come down because of that, because people may not demand goods and services, or the demand may. But it was also caused by supply. It is a twin shock from demand plus supply. Because businesses, when they were closed down, they were closures and lockdown, then both got affected. So this was unprecedented. Normally it happens that both do not operate in the same way. So twin shocks operated because of the lockdown, and then finally the demand also went down because people went out of job, and small business and others were closed down, and so on and so forth. So that is also important. And then government fiscal policy, how much government is spending and how much taxing. Taxation, sometimes government provide taxation relief. So if it goes down, then people will have more money in their hand, and their domestic their spending may go up. So I'm not going to that detail of domestic. You can go through my slide. And monetary policy is when RBI tries to control supply of money. And you may recall that there are various ways RBI can do it. Like one is called bank rate, reserve ratio variation, CRR and SLR, and the open market operation, when RBI enters in the market, either buys the bond or sells the bond, buying or selling, buy or sell bonds, government bonds. So all these either may increase supply of money in the economy, through the banking system. The supply of money is increased, rate of interest comes down, cost of borrowing, and they may have positive effect. If inflation is running, then RBI may cut down, and because of that, rate of interest may increase. Fund of cost of fund may become costlier. And please remember that rate of interest affects not only but various things like the bond prices. There's inverse relationship. It may also affect the cost of equity, that is the rate of return required, because you may recall that CAPM equation is RM minus RS. This risk-free rate is the without risk, and over and above, interest rate gets affected into the risk of the security, beta. So all these, so bond prices and other. So that is why, and in India, RBI signals of whether increase, tight or relaxed monetary policy by announcing the repo rate. The rate at RBI will provide financial accommodation to commercial bank. If repo rate is increased or decreased, then that may signal that whether what kind of policy in India. For example, in India, RBI has a mandate to maintain 4% inflation plus minus 2%. It may. So 6% not and lower than like this. So it has a mandate. So it has to inflation targeting, it is called. But inflation in recent times has, shot up more than this. So that is why monetary policy is very important, because it either will inject money in the economy or will suck it through the banking system, and that will make the fund costly, and naturally it gets affected. So details are given in my slide, deficit financing and all that. You can go through. I'm leaving, I have already explained. Now some of the, you can, for example, if GDP goes up, it creates a positive effect. Industrial production increases, positive effect. Inflation detrimental effect on stock price. To high, it leads to high interest rate and price earning ratio, that is the goes down because and makes equity market less attractive. Corporate profit is increasing, then it has good effect. Unemployment is increasing, then it affects negatively. Budget debt surplus are generally positive, but deficit are usually not, because if you have government has deficit, then it's spending more, than that may revive the economy, but it is. And weak dollar here, just forget this dollar, weak rupee, you can write it, no problem. So it affects the Indian, you can write it, no problem. So same explanation, a weak dollar may affect the export positively, but import may also be affected because of that. It may become costly. Interest rate, again, a high interest rate has a negative effect. It casts effects on and supply of money, growth, whether it is increasing. So this is a snapshot of some of the factors which may affect it. When you get the slides, you can go through. Now, one more thing I will just like to point out about business cycles. That business cycle is one important factor, because some of the investment strategies, they are based on cyclical business cycle. You may recall that business cycle is the swing in business activities. Economy, if you look at this, sometimes there is a up and down. This, for example, economy may be at peak, the GDP, then suddenly there is a turns to lower side. In trough is the lower turning point. Then again there is a revival. So what we call recession and prosperity, and so this is a common feature, of all the economies. It may last 2 to 10 years, and when it lasts with longer than that, it means that the economy is in depression, more than, for example, depression of 1930. So what happens that because it's cyclical, some industries are cyclical. They move with the business cycle up and down, and some they are not affected. So like they are sensitive, and there are some which are less sensitive. Like the goods which are necessity, they are not sensitive. But like some goods which are capital goods, they are very sensitive because all the capital goods they are machineries, equipment, and other they are used for further production. So if economy is not performing well, investment will not be made. So they are very sensitive. And because of sensitivity, what happens that if a company has got a large proportion of cost, fixed cost, there are two which cannot vary with the output. The more you produce, the less produce, you will still pay. Variable cost you move with the same. And there are certain cost of borrowing, which we call how much you have borrowed through debt and through equity. So debt is also a fixed, payment, interest rate you have to pay it. So this is called operating leverage. How much is cost and how much is called financial leverage in interest payment. So if a company, its product is sensitive, very sensitive to business cycles, like so if it has got high proportion of fixed costs, so naturally its sales will go down and it has still to pay the fixed cost. And if this portion is high, then interest payment has to be paid, irrespective of the performance of the company. So that is why these get affected because of this, the operating leverage and all these explained. So it depends upon the sensitivity of some are very sensitive like consumer durables because when people find it that they do not have income, they will buy TV and every car and other thing, they will postpone it. And these industries, they have a high beta and they move greater than one, move more than market. And there are certain industries like food and pharmaceutical, public utilities. People will continue to buy these because that irrespective of that, so that these are essential items. So they are defensive industries. If you make investment, they may not be very sensitive to. So that is why one type of investment may be that you look at whether based on the cyclical effect of the economy, that how sensitive they are and how they are. So there are various indicators, some tell us whether the economy is headed where. For example, consumer durables is an indicator. If consumer durables demand goes down, it is indicated that onset of recession in the economy. Capital good demand goes down, it is indicator that economy is headed toward. Some happens with the a company with a business cycle, and some information we have with a lag. So there are indicators in the economy which we can understand by looking at whether we are heading. For example, P ratio is one of the leading indicators of the economy. Also, if you look at stock prices, are called the leading indicators. If stock prices reflects information about the economy, it can tell us in advance where. So all these indicators and all they are explained here given in my slide. You can go through these things. Now the economy and financial market, as I pointed out, that economy affects the businesses and it affects the financial market via various channels which I have discussed with you. What the efficient market says that you cannot use the information the past public or private information to make abnormal return. What the implication of this thing for economy wide analysis is that you cannot use this information to make abnormal return. Please note the word abnormal means more than mandated by the risk. In normal return is required, otherwise nobody will use it. Like, let me just tell you why. For example, a budget. You cannot use some information contained in a budget to make abnormal profit. For example, if you take this is the event, before and after, if you look at the return of a stock, there should not be any difference before and after the budget. If there is a, then it means you cannot get abnormal return by using. For example, you think that some industries may be taxed heavily, so you take action accordingly. So that is why it cannot, and so these information one cannot use to make abnormal. Now, economy-wide information, how can we use it? I have just explained to you. Mostly they draw upon the macroeconomic factor, economic policies, monetary, fiscally, GDP, inflation, interest rate, employment, and other indicators. And then companies operate in industry. Industries are affected. There are, and you know that there are market structure ranging from perfect competition, an ideal situation, to monopoly, to monopolistic, and so there are various players. And then industry classification is based on also, various classification are there based on the types of product they make it. So industry analysis is also very important because when you are operating in a market, you are affected by what your competitors are doing, your competitors. So that is why there are two methods which are usually applied to understand industry. One is the Porter's model, which you have already studied, 5 forces model. Let me just show you, I think. This model, you already know it. Like theory of this model you already know. You have already studied, I think, in various courses. Threat of entry, rivalry between existing competitors, what are the various substitutes, pressure, bargaining power of buyer and seller. You may recall that one of the assumptions behind any market when is like in perfect number of sellers, by number of buyers and sellers, entry condition, like types of products, substitute are, so this same thing has been used by this year. Entry and exit condition, whether a firm enter can market or leave the market, and so on. So this is based on that. So Porter's model you have already done in, I think, in maybe in international business, or you must have studied. Have you studied or not this?
Yes, sir, we did.
तो इसको पढ़ लीजिएगा और फिर उसके बाद बात करेंगे, ठीक है? इसको मैं पढ़ा नहीं रहा हूँ क्योंकि बहुत टाइम कम है और पढ़ाना बहुत है। अभी इसको अगर लेके बैठ जाएंगे तो कवर भी नहीं हो पाएगा। तो ये मैंने आपको ये बताया है कि नेसेसिटीज, ये सारी सेंसिटिविटी वाली बात मैंने यहाँ एक्सप्लेन भी कर दिया है। ये सारी चीजें स्लाइड मिलेगी, पढ़ लीजिएगा। तो सेक्टर रोटेशन ये होता है, व्हाट इज डन इज दैट अकॉर्डिंग टू साइक्लिकल नेचर आप कहाँ इन्वेस्ट कर रहे हैं, यानी अक्रॉस दिस साइकिल यू शिफ्ट योर इन्वेस्टमेंट। तो इसको पढ़कर इसके बाद से इस पर कोई बात होगी तो आप बात करिए। मैं इस वक्त थोड़ा सा इंडस्ट्री लाइफ साइकिल के बारे में आपको बता दे रहा हूँ। आपने प्रोडक्ट लाइफ साइकिल पढ़ा है, तो इसी तरह से देयर इज इंडस्ट्री लाइफ साइकिल। कुछ इंडस्ट्रीज स्टार्टअप स्टेज में होती हैं, फिर कंसोलिडेट करती हैं, देन दे मूव टू मैच्योरिटी एंड रिलेटिव डिक्लाइन। So what happens to one of the most important indicator is that when a company is starting rapid sales growth, then they attain stability, and then maturity comes, that the sales they reach, the growth become declines, and then maybe minimum or it may become negative. And in this stage, what may happen then, if a company is growing, there are various investment opportunities. So when there are various investment opportunities, so and then you may find that the company is not earning profit even in some cases, but sales are growing because it's applying back the investment for further and further. Whereas when you reach this stage, maturity stage, then investment opportunities may be exhausted. So they may have what we call cash cow. So they return like these type of when your company is in maturity stage. So they are very high dividend paying companies. You see that some of the companies like Hindustan Levers and all that, they pay very high dividends. They do not have, whereas if you see some very IT companies, other companies, they are growing. So they do not pay much because they plow back the investment time. So that is why in order to, this is diagram, industry life cycle. So start consolidation, maturity, same diagram which we have studied in product life cycle, but in different ways. So like, various, especially nowadays, we find that the companies which are, IT companies and other companies, so they are, the startup companies, then they consolidate and then penetrate the market. And whatever, for example, many companies, they die here only. That is why 90% of these startups, they die. So whatever the survivors, they consolidate. And then a time comes when they reach a maturity stage, and here the profit competition may intensify, profit may become narrower, and by the time the certain products, they may decline or shrink, like VCR, DVD, and other tools taker. So here the only thing which remains that the new competitors, new product may come in like that. So all these are explained in my slides. So where you make investment and log, and I will tell you today. You go through these things, and then we will discuss if there is something. That there is a very famous investor. His name is Peter Lynch. You know that people give a strategy, the where to make investment. So he made a remark that many people prefer to invest in a high growth industry. Any sales are growing. High growth means sales growth are increasing. Where a lot of sound and fury, because if sales is growing company is there is a chances, that you will earn high return. I prefer to invest in a low growth industry. You see that contrarian. In a low growth industry, especially one that is boring and upsets people, such as funeral homes. Please remember that in US and Western countries, funeral is a very costly proposition. That if you want to give a good burial, so that costs a lot of money. It's not that cheap. There is no problem with the competitor. You do not have to protect your flank from potential competition. That gives a leeway. This is one of type of strategies. What is saying that everybody is investing in high growth. So that is why there are some contra investment in contrarian. This logic is that in this type of in the investment, there are not many competitors and there. So that the opinion may differ from this. I was pointing out that by explaining to you that the potential and all the industry life cycle, I am not prescribing anything that you make investment. But normally it happens that the companies which have got high potential of growth, they are also, they provide higher return because, if a company is growing or shrinking, so it may not, it's a prospect in the future may not be good. The future may not be very bright. So with this, I have briefly covered economy and industry level factor which affect the fundamental. Now the third aspect is company valuation, company level analysis. And here tomorrow I will briefly just tell you about some of the things like financial statement, ratios, and other things, but I will not go into accounting way. This will tell you very clear. And then we will take some real life example of, how these can be interpreted, these data. because my task here is not to teach you about accounting, but I may refer some of the things, because you know you have to look finance different from accounting. You are not supposed to make a income statement or balance sheet or financial statement, and but you should be able to interpret that data. What does it mean? And please remember that in one class or other, it will not become master, because the more you know. So tomorrow I will take up that. And I would also like to make announcement that maybe by tomorrow you will get your first assignment, which you have to submit maximum in a 5 to 6 days, because 9th February is the last teaching day, as I've been informed. And before that, all things have to be closed. So we have to, and then 2 assignments and 1 test I will take. So 1 assignment and 1 test and 2 assignments. So test is compulsory, assignment is also compulsory. There is no optional. So your 70 marks for this evaluation will be based on 1 test and 2 assignments. And I do not know, I have not checked how many of you have joined Google Classroom. I have sent the link. How many of you have joined? Three, four. This shows that how serious you are, I will check it. And please remember that those who are not joined or have not, there will be a penalty, for that. That it is not that you can submit the assignment for unlimited period, because we have got other obligations as well. So please join if you haven't joined. And I have also, preparing the attendance. I will see to that, that hardly 50% of the class, 50% of the class is attending. So that is also shows that how much they have learned about finance and other. So by today, all of you should join Google Classroom. So tomorrow I'll meet and we'll discuss the rest of the things.